Hello and welcome to my YouTube channel, the Corcoran Codex, and the subject for this video relates to what is known as the shadow banking system, and I'm going to give some definition as to what that is, and also I'm going to examine some current problems or woes that are beginning to appear in the private credit world, which of course is actually part of the shadow banking system. So what I want to focus on in this video has to do with what is known really as the shadow banking sector of the financial economy. Now, shadow banking is one of those terms that's quite often used, but maybe not necessarily widely understood. What we are really looking at are those kinds of financial firms, intermediaries, that are not part of what we might call, say, the mainstream financial sector, such as banks, insurance companies, pension funds, but maybe are more in the world of, say, asset management, alternative asset management. And we can include firms like, say, private equity firms, private credit firms, even perhaps hedge funds and other kinds of alternative funds in that definition of shadow banking. Now, what makes this particular video timely has to do with some developments that have been taking place, say, in private credit in recent times, as this is being recorded on February 20th, 26. And I'm going to start by looking at this headline really from the New York Times Deal Book, which is a newsletter, quite a useful one. And as you can see, the headlines ask the question, is this private credit's canary in the coal mine? So it is referring to one of those types of financial intermediaries, private credit, which, as I said a moment ago, is best thought of as being within the shadow banking system. Of course, the commercial banks, the mainstream commercial banks, are highly regulated, especially, say, since the '08 crisis in more recent times, by the Basel Committee rules which cover global banking, whereas the shadow banking system is much more lightly regulated. One might argue not regulated enough. Anyway, just to continue from what's on the screen now, you can see the question has been posed, and it goes on to say that steep declines in the shares of private lenders or private credit firms after a major fund changed how investors can withdraw money have sparked worries about more trouble to come, the idea of the canary in the coal mine. So let us now dig a little deeper and see what this headline is really all about. We're going to start by talking about a firm called Blue Owl Capital. And as you can see, I've basically headlined this slide with this idea of a gotcha. Now, Blue Owl Capital is a private lender, a private credit fund that provides loans to small, medium-sized businesses. It has three funds, Blue Owl Capital, and one of those funds allows retail investors to buy shares. I put buy in inverted commas. Essentially, they are buying into a fund which then gives them participation in the loans that have been granted by Blue Owl Capital. Now, the gotcha, if you like, or the illusion, is that the original loans, those granted to these companies, which are typically long-dated assets, then can be matched against short-term liabilities, i.e. the shares that have been sold to the investors, and especially in this case, to retail investors. When investors want redemptions, they want to basically sell their shares, this creates a liquidity crunch for Blue Owl Capital because the assets, the loans, long-term, and the idea, the illusion really, is that these shares that the investors own and which they can sell obviously are quite short-term. You could very much think of it in the same way as banking, where banks have long-term loans, hold government bonds, what have you, but they can also face literally withdrawals overnight in terms of demand deposits. Now, when investors want redemptions, what happens is that Blue Owl Capital has to then come up with the funds, the liquidity, to meet these redemption requests. And as can be seen in a moment, there have been considerable redemption requests for both Blue Owl Capital and some other private credit firms. What has happened in recent times, given disruptions caused by AI, is that there have been some major drops, large losses incurred by some of the firms, especially software firms maybe, that companies like Blue Owl have been loaning money to. So when Blue Owl was faced with these redemptions, what it did was start to sell some of these loans. And if obviously there's a difficult market where the loans have been granted to companies where the share price or where the valuations are dropping dramatically, this creates a liquidity crunch. And in fact, what Blue Owl has done is to impose restrictions, or gating as it's sometimes called, on allowing the investors, especially the retail investors, from being able to sell their shares or redeem their participation in these funds. Let's actually have a look at the chart which I've created as of February 2026, and this is soon after the markets opened in New York. And as you can see, this is the share price of Blue Owl. We go back, say, roughly a year. You can see we at one point were up here in the region of 2021. And as and when the market opened on Feb 20th, the share price has dropped down to around $10.50, actually exceeding to the downside the more recent low back here at around $11. We're now sitting at about $10.50. Now, as you can see, the technical chart does not look good. We are way below the 200-day moving average, and you can see that the blue line, which is the 20-day moving average, has dropped to here below the 50-day moving average in what's basically a bearish crossover, and we've actually come all the way down, even exceeding these volatility bands down here. And as I said, we opened at $10.50. Blue Owl has disclosed that because of the problems I mentioned, say in the software sector, it sold $1.4 billion worth of loans from its funds, and it reported that it took virtually no loss. And half of the proceeds from selling those loans went to redeem investors in one of the funds. And you can see the quote here from the Blue Owl co-president, who says, "I'm getting congratulations from everyone in our industry." And an analyst at TD Cowen wrote in a research note, which was published Thursday, February 19th, that the transactions suggested there are no cockroaches lurking in the portfolio. Now, that is obviously an upbeat, positive assessment of the situation, but there have been more gloomy and pessimistic interpretations of what is going on, and many people are beginning to sense that there are these tremors beginning to show up, not only in the private credit world, but perhaps elsewhere in the shadow banking system. The Trump administration has made it easier for individual investors through their, say, 401k plans to put money into private equity and private credit. And as I have indicated, perhaps the more acute problem arises with regard to one of the three funds that Blue Owl has, which is focused on the retail market. In the United States, Senator Elizabeth Warren has urged the Trump administration to wake up and demand more disclosures and stress tests for private lenders, especially those who have a retail fund. So the knock-on effect from what has happened to Blue Owl can also be seen in some other major asset management firms, or again, part of the shadow banking sector. For example, Apollo Management. What I've done here is show the opening essentially quite early on in the trading day on February 20th, 26, and we can see again the chart for Apollo looks pretty grim. And as of when the market opened on this day, we had actually registered a new low going back around 9-10 months. And just to confirm the trend, We can see as of the opening really on February the 20th, we can see another new multi-period low for Blackstone. I want to turn to general conditions in the credit markets, and I want to pose the idea that despite these early indications of tremors perhaps in the shadow banking sector, there is still a remarkable amount of complacency with regard to credit risk and credit spreads. So what I've done here is go to the Federal Reserve's website, FRED, and I am showing you what is known as the high yield spread. And what this shows essentially is the spread, the difference in yield between, say, a 10-year US Treasury, a credit risk-free instrument, versus the yield on, let's say, a 10-year high-yield bond. A high-yield bond means that this is sub-investment grade. And as you can see over here on February 20th, we are below 3%. In fact, the number's right there, 2.86%. And if you look across the timeline here for the last 5-6 years, you can see just how extraordinarily low this spread is. And what it's showing is that in the credit markets, there is very little risk premium, hardly any really, less than 3%, for taking on the risk of owning a sub-investment grade credit versus a risk-free, from a credit point of view, that is, US Treasury bond. And just to conclude, what I would say is that we might be seeing the canary in the coal mine, just to go back to the New York Times deal book suggestion. But what we should really be looking for is some suggestions coming from this particular indicator, the high yield spread market, that there is in fact increasing concerns starting to develop in the broader corporate credit markets. Well, thank you very much for watching that video. I hope you found it useful, and I would like to encourage you to subscribe to my channel, the Corcoran Codex. There is no obligation. You're not required to pay any money to me, but you will then be notified as to when I release new videos, which I do fairly frequently, and all of those videos are centered around the subject on the screen, which is analyzing critical ideas and episodes in the world of global finance.